Hi, welcome to my lesson. I'm your lecturer in Financial Accounting 1. So today we are going to learn double entry bookkeeping system. So upon completion of this chapter, you should be able to understand the process of recording, accounting data in business. You are able to provide a grounding in double entry bookkeeping, and you are able to identify transactions and events and how to record its journal entry. And next, prepare journal ledger by using T account and explain the relationship between debit and credit entries in the trial balance. And lastly, you are able to prepare a trial balance for a company. So this is the very important chapter, and I hope that you can pay more attention in this chapter, because this chapter explains the most important concept in accounting: double entry. So what is double entry? Double entry system in accounting refer to every business transaction will involve at least two entries, and these two entries we can use debit and credit to present, and ultimately the account will be balanced as the total amount of the debit side will tally with the credit side. So what is this paragraph trying to say? It means that every business transaction will have debit and credit. The amount of the debit and credit will be the same. So because of this duality concept, at the end of the day, the total debit will equals to the total credit. I will explain this in detail later. So let's take a look on the accounting record flow. So this explains how we prepare the financial statement. So the first step you have to do is you have to identify transaction and events. You have to identify whether this transaction belongs to the company and how you record. Next, after you identify the transaction and event, you are able to record in a journal entry. This journal entry will be posted in general ledger. And lastly, we will pass some adjustment entry and we will get the trial balance. So in this chapter 2, you can learn how to identify the transaction and event, and you can translate those transaction and event into the language in accounting we call journal entry. So journal entry refer to one debit and one credit. I repeat, we identify the transaction and event first, and then we translate the language, the transaction or event into the language of accounting, debit and credit. And then at the end of the day, we have trial balance of the account. And based on the trial balance, this is the product of accounting: financial statement. Financial statement is the product of accounting. So basically, financial statement, we have 5 types of financial statements. We have 5 types of financial statement. The first one, income statement. Income statement. So what is the purpose of income statement? The purpose of income statement is to present the financial performance of the company. So how we say financial performance of the company? What are the things that we want to know from the income statement? We want to understand whether the company is making profit or making loss. We use income statement to present the financial performance of the company. So from the financial performance, we can understand whether the company is making a profit or making a loss. Next, The next statement in financial statement is called statement of financial position. Statement of financial position. And from the statement of financial position, we can understand the asset, liability, and equity of the company. So when you can show the asset, liability, and equity of the company, we can understand the financial position of the company. How much of the asset that the company have, how much of the liability that the company have, and how much of the equity they have. So from the statement of financial position, we can understand the financial position of the company. Next, the next statement is statement of changes in equity So the purpose of statement of changes in equity is to show the movement in your equity account. Next, the next statement we have is cash flow statement. So from cash flow statement, we can also understand the cash flow movement. And lastly, we have notes to the financial statement. And from the notes to the financial statement, this provide additional information for the user. And for your information, in FA1, we focus on income statement and statement of financial position. The other three we will cover in your FA2. That's why I don't want to have too much of explanation on these three statements, because that will be covered in your FA2. I will focus in income statement and statement of financial position. So we will use a short form in future lesson. So for income statement, the short form we use is IS. The short form of statement of financial position we use is SOFP. Next, before we learn the double entry concept, I think we shall also understand the meaning of key terms that we use in the preparation of accounting. The first one is revenue or sales. So what is revenue or sales? The cash that you receive from the ordinary business activity. So for example, let's say you have a stationery shop. You sell stationery, you sell book. This is your revenue. For example, Crescendo. Crescendo is an educational institution, so we provide lesson, we provide classes to students. So when we collect the tuition fee from you, this is your revenue. This is the revenue for the college. Next, purchase. What is purchase? Purchase is the cash you pay for the goods or services that will be used in producing of goods or providing of service of entity. For example, you have a stationery shop, you buy stationery and resell to your customer, right? So when you buy from your supplier, we use purchase. Another example, handphone shop that we use in chapter 1. In order to sell handphone to your customer, you need to buy from your supplier first, right? So when you buy from your suppliers, we use purchase. So in accounting, we rarely use buy, so we use purchase instead. Next, income. Income is the cash received from non-ordinary business activity. Cash received from non-ordinary business activity. So I have question, how we distinguish revenue and income? Because both is cash received, but the difference is revenue is based on ordinary business activity and income is a non-ordinary business activity. I will explain this in a diagram. So imagine this is Crescendo. So Crescendo, what is the ordinary business activity? We provide education. We provide education to students. So when students come to school, they have to pay what? They have to pay tuition fee. And when the college receives tuition fee from students, they will gather all the money and they put this money to what? To bank. In return, bank will pay to college what? Interest, income, for the money that Crescendo saved in bank. So my question, based on the example here, which receipt is considered as revenue, which receipt is considered as income? So based on the accounting concept, the tuition fee that the college receive is considered what? Revenue. And the interest that the college receive from the bank is considered as income. Why? Because the principal business activity for college is education. So the cash that received from the normal business activity will classify as revenue. Why? Because of ordinary business activity. For the interest, this is something additional that the bank gives to college for the money that they save. And saving is not the main business activity for college, because the main business activity for college is provide education service. So this interest income we consider as income because it's non-ordinary business activity. I hope that this diagram is a very good example to show you how we distinguish revenue and how we distinguish income when we prepare the accounting. Next, expenses. What is expenses? expenses is the cash that you paid for goods or service to maintain the operation of entity. So we can compare expenses to purchase. You see, cash paid for the goods or service that will be used in producing of goods. Cash paid for goods or service to maintain the operation. So the difference between purchase and expenses here is purchase is considered used in producing, and expenses is for the maintaining. And we can use another example to explain the difference of purchase and expenses. So we use the same example. We use Crescendo again. So this is Crescendo, and this is me. I am TCP. So college have to pay me, right? Have to pay me, so I come to college to deliver the service, to teach you. Am I right? And at the same time, college will pay rental for the premises. College will pay rental for the cleaner. So, based on this diagram, can you tell me which payment is considered as purchase and which payment is considered as expenses? So the answer is the cash that college paid to me as a lecturer is considered as purchase, and the cash that the college paid for the rental of premises, paid for the cleaner, is considered as expenses. Why? Because the business activity for college is what? Education. So the fee that paid to me is relating to provision of education services. So this money is considered as purchase. However, the renter, the cleaner, those money paid to this portion is considered expenses. Why? Because these expenses is used to maintain the operation. But this purchase is related to the producing of revenue. You may have a question, sir, paying rental of premises or paying to cleaner also is producing of revenue, right? Yes, but this is indirect. But the fee that paid to me is considered as direct. So for the direct expenses, we consider as, the direct payment we consider as purchase because related to the revenue generation. But for the indirect payment, we consider as expenses because this is used to maintain the operation only. Next, asset. What is asset? Asset is an economy resources that can be used or controlled by entity, and it can be tangible or intangible. So basically, what is asset? Asset is something that you can what? You can control, and this can give you benefit from the using. So example of asset, we have what? Car, machine, factory, computer. Those are the assets for the company. And we know that asset can break into tangible and intangible. So what is tangible asset and intangible asset? Tangible is something that you can touch and is physical. Example, these are the example of tangible asset because you can touch, you can feel, you can physical sighting the car, machine, factory or computer. For intangible asset such as goodwill, license fee, and so on. Patent. For example, like Starbucks, they have a goodwill, they have license, they have patent. So those are considered as intangible asset. The brand name. Let me repeat again. What is asset? Asset is the resources that the company can control and they can enjoy the benefit of using. And asset we can break into tangible and intangible. Next, liability. What is liability? Liability is an obligation or commitment that the entity is required to pay. The key word for liability is pay. Example of liability: loan. You are required to pay loan, right? Because you're owing people money, you are required to pay. Next, equity. What is equity? Equity presents the net worth of the entity, and we can say this is the money belongs to the owner. Equity is the money belongs to the owner. Basically, the money that the owner invests in the company or the money that the owner can withdraw in future. Next, receivable. What is receivable? Amount due from customer. This is the amount to be collected from the customer due to credit sale. What is credit sale? You sell to customer but you did not collect the money immediately. Receivable is an asset of the company. So we can say that your customer is your receivable. But this happens when sale but without collecting money immediately. Next, payable. What is payable? Amount due to supplier. This is the amount to be paid to supplier due to credit purchase. What is credit purchase? You purchase from your supplier but without paying money immediately. Payable is a liability. So we can say that your supplier is your payable. And take note that receivable is the asset because you can control them. You can collect money from them in future. So it's your asset. Payable, you are required to pay in future. So this fall within the definition of liability. So payable is your liability. Next, share capital. Share capital refer to the investment sum contributed by owner for the entity to expand their business or for operation purposes. Last, drawings. What is drawings? The owner of entity use the cash of entity for personal usage. Sometimes the owner will take the money from the company because of personal using or for taking profit. This is also a possible reason. So when the owner take the money from the company, we use the terms drawings. So these are the key terms that will be used in the accounting. And we also need to understand what is income statement entry, IS, or statement of financial position entry, SOFIP. IS entry, transaction that will affect the profit or loss of entity. The example, revenue, purchase, income, and expenses. Next, SOFP, transaction that will affect the company asset, liability, and equity. So based on this explanation, IS entry affect the profit or loss, SOFP affect the company asset, liability, and equity. We can do this marking. Revenue, purchase up to expenses, these are IS entry, items that will appear in the income statement. And from the asset up to drawings, these are the SOFP entry. And you also need to take note that a journal entry may consist one IS and one SOFP, or both IS entry or both SOFP entry. It means that it did not come with a pair. You can have two IS or you can have two SOFP, or one IS or one SOFP entry. So that's all for the explanation of part 1 video in your chapter 2, and I will continue part 2 later. Thanks for watching.